Welcome to the Explainer. In 2025, precious metals didn't just rally, they pretty much rewrote the rules. And today, we're going to break down exactly what that means for your strategy heading into 2026. All right, let's jump right in with a number that's just staggering: 138%. That was the approximate one-year return for silver in 2025. I mean, that's the best performance for the metal since 1979. And it wasn't just silver. Gold absolutely smashed its 50th record high of the year, blowing right past the $4,500 an ounce mark. You have to understand, this wasn't just another bull market. This was a fundamental structural shift. So you gotta ask, right? What on earth was behind this explosive move, and how do we prepare ourselves for 2026? That's the core question we're digging into today. Here's how we're gonna break it all down. First, we'll get a handle on the situation. Then, we'll look at the critical complication, the thing that makes this time so different. And finally, we'll get into the actionable stuff, what this means for your portfolio. Okay, so let's start with the what happened. This was a rally driven by some incredibly powerful macroeconomic forces, stuff that went way beyond the daily news cycle. The primary theme here was what analysts are calling the debasement trade. It's a pretty simple idea, really. As governments ramped up spending and central banks fired up the money printers, investors all over the world started looking for a safe haven, a place to hide from their cash just losing its value. And this slide, man, it really shows you the perfect storm that was brewing. You had the Fed doing a complete 180, governments borrowing at a pace we've never seen, inflation that just would not go away, and a massive rotation out of pricey stocks and into real hard assets, especially led by central banks in the East. But here's the thing. This rally was fundamentally different. It wasn't just about the price going up. It was about a deep crack that appeared in the very foundation of the global market. So the crucial point isn't just that prices went up, it's how they went up, and maybe even more importantly, where they went up. This was not some unified global event. It really became a tale of two markets. In the West, New York, London, the game was all about paper contracts, futures, options, basically bets on the future price. But in the East, led by Shanghai, the demand was for one thing and one thing only: the actual physical metal. And this chart just illustrates the disconnect perfectly. I mean, just look at these numbers from Christmas Eve 2025. While the Western markets were quiet, physical silver in Shanghai was surging towards $85 an ounce. That's an incredible premium of over $12 compared to the paper price in New York. Folks, that's not arbitrage. That's a fracture. Okay, now let's get to the catalyst that turned this market fracture into a full-blown strategic choke point. And this is what makes the situation for 2026 so incredibly urgent. This timeline shows exactly how we got here. It all started in October when a massive physical order in London caused the market to completely seize up, exposing just how little metal was actually available. To stabilize things, a record amount of silver had to be exported from China, which absolutely decimated their domestic stockpiles. Well, Beijing's response was swift and decisive, and it all led up to a hard deadline, January 1st, 2026. So the crucial point is this. After watching its own reserves get drained to prop up Western markets, China has effectively turned off the tap. With this new export system, it's making a fundamental shift from being a key global supplier to a strategic accumulator. And it's prioritizing its own massive industrial needs. So given this new reality, where physical supply is being ring-fenced by a major player, how do you even position your portfolio? Let's look at the main tools you have at your disposal. This table breaks down your three main options, but I really want you to focus on the key risk for ETFs in 2026. These funds, the ones that trade like stocks and are supposed to track the metal's price, they face this massive risk that their paper price completely decouples from the real physical price. And this isn't just a theory. The paper market is dangerously over-leveraged. Some estimates suggest a ratio as high as 356 to 1. Think about that. For every 1 ounce of available physical silver, there are 356 paper claims on it. That's exactly the kind of risk that becomes critical in a physical supply squeeze. Now, let's see how all this builds into a coherent strategy. Based on everything we've seen, there are really two primary ways to approach your allocation, and it just depends on your risk tolerance and your conviction. On one hand, you've got a bounce approach. You can think of it as playing that broad debasement theme, with gold as your stable anchor. On the other, there's a more aggressive, silver-focused strategy. This is a direct bet on the supply squeeze and silver's dual role as both a monetary metal and an absolutely essential industrial metal, especially for things like solar and EVs. So, as we look ahead, what is the single most important takeaway from the chaos of 2025 as we build our strategy for 2026? This quote from analyst Stephen Innes just captures the fundamental shift perfectly. The old anchors of the financial system, faith in government bonds and currencies, they're losing their hold, and hard assets are rushing in to fill that void. The key takeaway is this: the market is moving past a system where paper derivatives dictated the price. We are entering a world where having access to the actual physical metal is what defines its true value. China's move wasn't just a policy change, it was an acknowledgement of this new reality. And this leaves us with a final thought. As the old system decouples, deciding how you own these assets, whether it's as a physical certainty or just a paper promise, that might be just as important as deciding to own them at all.